Welcome to This Explainer. Today, we're decoding the structural impacts of inflation on your money and exploring some highly actionable strategies to protect your purchasing power. We're talking about taking complete control of your financial toolbox so your wealth doesn't just sit there gathering dust, but actively defends itself. So let's just dive right in with a pretty tough question that everyday savers are grappling with right now. Are your savings secretly shrinking? You might be diligently tucking money away every single paycheck, but the economic ground underneath us is shifting way faster than traditional savings accounts can handle. Just look at this staggering number, 35.6%. According to OECD data analyzed in a recent Excelsior report, consumer prices have skyrocketed by exactly that much from December 2019 to January 2026. Let that sink in for a second. This means your traditional savings, the cash just sitting in standard legacy bank accounts, are actively losing real-world value. Essentially, if your money isn't growing, it's shrinking. Here's our roadmap to fight back. We're going to cover the silent wealth erosion, the high-yield savings defense, the bump-up CD, decoding Series I bonds, and finally, your inflation action plan. Okay, Section 1, the silent wealth erosion. Let's look at exactly how the middle-class budget is fundamentally changing before our eyes. Housing costs alone are now devouring a full third of middle-class disposable income. That's up significantly from the 1990s when it sat closer to a quarter. And, when one essential category eats up that much of the pie, it puts an incredible squeeze on literally every other financial decision you make. The Excelsior report really hammers this home. This isn't just a temporary blip, it's a structural reconfiguration, forcing households into financial fragility. Incomes are stagnating relative to these higher costs, and the price jumps in everyday essentials had permanently reset our spending baselines. The strain is incredibly visible. 1 in 8 middle-income households now hold debt that exceeds 75% of their total assets. Consumers are adapting by trading down and relying heavily on credit. And this right here is exactly why your savings strategy needs an urgent upgrade. Section 2, High-Yield Savings Defense. Now that we've diagnosed the macro problem, let's build your first line of defense, starting with your highly liquid cash. Your easiest weapon against inflation is a zero-fee high-yield savings account. According to Forbes' May 2026 analysis, the yields are super competitive right now. SoFi offers up to 4% when you use their boost. Axos One hits 4.21% with a bundled approach. And Varo, they reach an impressive 5% APY with direct deposit conditions. The best part of all this? 0 monthly fees across the board. The main takeaway here is that you've got to be ruthlessly picky about where you park your short-term cash. Ditching those zero-interest legacy accounts is step 1. Inflation-proofing means your emergency fund is totally accessible when you need it, but it's actively growing risk-free in the background. Moving on to Section 3, the bump-up CD. Moving up the ladder for medium-term goals, we need a tool that balances guaranteed returns with agility. Financial institutions like Synchrony highlight the bump-up CD, which completely prevents the classic trap of locking in your money right before interest rates climb. With a traditional CD, you're locked in, right? And if you want out early to chase a better rate, bam, you get hit with penalty fees. A bump-up CD changes the game entirely by offering a one-time option to increase your interest rate if market rates go up during your term. Basically, this gives you the freedom to literally bump your rate up to match inflation trends, keeping your medium-term savings competitive without paying a dime in penalties. It's a remarkably smart play for short or medium-term goals. Synchrony, for instance, offers a 24-month term option where you get the safety of a guaranteed return, but you keep the agility to capitalize on shifting economic winds. Section 4, Decoding Series I bonds. Let's move on to our heavy hitter for long-term protection, a government-backed asset that's incredibly relevant today. Keel Financial Partners notes that Series I bonds have become highly attractive, but they do require a bit of strategic understanding. Esteemed financial author Zvi Bodhi literally calls them America's best-kept investing secret. So why the high praise? Well, here's the magic behind them. Your return actually has 2 distinct parts, creating what's called a composite rate. It combines a fixed rate that is locked in for the life of the bond, which is up to 30 years, and an inflation rate that resets every 6 months based on the consumer price index. This dual structure ensures your money will literally always outpace inflation.
Let's look at the actual math for right now. For bonds issued from May through October 2026, you lock in a 0.90% fixed rate, right on top of the 3.34% annualized inflation rate. That nets you a really solid 4.26% total return. And remember, even if inflation somehow drops to absolute zero tomorrow, that 0.90% fixed rate is yours for the next 3 decades.
Comparing this to other assets shows exactly why buying an I-bond right now is historically a fantastic deal. You're guaranteeing a 0.90% real return above inflation for 3 decades. Look at a 12-month Treasury bill sitting at a 3.75% flat rate as of April 2026. The I-bond not only beats it in yield, but its interest is tax-deferred, giving you a whole other layer of efficiency. But, of course, you must play by the government's strict rules, meaning this cash is locked up tight for at least the first year. You can only purchase up to $10,000 per person per year exclusively through treasurydirect.gov. And definitely take note of step 3 here. If you cash it out before 5 years, you will forfeit the prior 3 months of interest. It's a phenomenal vehicle for sure, but it demands a bit of patience and commitment. Which brings us to our final stop, Section 5. The Inflation Action Plan. Okay, let's pull the whole shebang together into a cohesive strategy for your everyday wealth. By diversifying your savings across these specific tools, you stop the silent erosion and force your cash to work as hard as you do. First, protect your highly liquid emergency funds by moving them to high-yield savings accounts earning up to 5.00%. Second, deploy bump-up CDs for medium-term goals so you get flexibility without the fear of penalties. Third, utilize Series I bonds for your long-term guaranteed inflation-beating growth. And lastly, continually evaluate fixed versus variable rates so you stay ahead of the curve. As we wrap up this explainer, I really want you to take a hard look at where your money is sitting right now. Is your savings strategy built for the low inflation economy of 2019 or the high-cost reality of 2026? You have the tools now, but knowing isn't enough. The clock on inflation is ticking today, so what will your very first financial move be tomorrow morning?